Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. Michael Burry, the Big Short, has deleted his Twitter account again, and this time he left with a parting message. I want to show you that first. The next thing we need to talk about is stopping inflation, what the central banks are doing. Then we need to talk about the traffic jam that is taking place outside of China and what that means for you. And then at the end, we will talk about the turbulence in the stock market. I've got all of that and more. Let's begin. Here you can see Michael J. Burry. This account doesn't exist. It's not the first time he's deleted his Twitter account, but on the way out, he left this message. At least I tried. I thought that was very interesting for something to say as you move out. But obviously he's talking about what's happening with inflation, with the markets, and does believe that there will be a catastrophic event at some point. He's not saying that it's happening tomorrow, let me tell you. And if you look at what he said, like if you read each and every tweet, which you can do, not at Michael J. Burry, but Burry Archive. All the links will be in the description. This is from the Burry Archive. And you actually see that and understand the guy, it makes a lot more sense. If you just watch the movie, you're only going to get not even a very good interpretation of it. Anyway, read his tweets. Interest rate increases and surging inflation may totally wipe out the extra savings that consumers built up during this time over the last couple of years by 2023. In fact, if you look at the actual savings rate, you will notice that it is already back to where it was in 2019. But taking it a step further, you can see very clearly right now that inflation is killing, absolutely killing all of the gains that have been made in people's wages. There are now serious risks to the Goldilocks scenario of slow rate increases and a soft landing for the economy that would benefit commercial banks. Central banks may ratchet up rates too quickly while failing to control inflation. You know what's going on today. Food prices, energy prices, my goodness. The liquidity buffer that households have built up over the last few years will shrink much faster. We have increases in interest rates that we knew were coming and that will start creeping up in mortgage payments. But now you have inflation, notably energy and food, that's hitting consumers hard. This happens to be Canadians. It's going on all over the place, okay? If you imagine what people are paying right now for their mortgages, for their credit cards, for their personal line of credit, for any type of debt, that's all going to increase. But at the same time, look at the national debt and understand that they are paying this interest rate and it's going to go into a level that is simply unaffordable. Bundesbank warns Russian gas embargo would cost Germany 5% in lost output. Central bank says a sudden disruption of supplies to the EU could trigger a sharp recession this year. We are watching something that is extremely, and I'm going to use the word properly, unprecedented, because there's this huge dependence on Russia for gas. There's a huge dependence on Russia for a lot of different things, in fact. They output so many different products. And hey, if both sides are agreeing, everything's great, hey, no problem. But what happens when there starts to be a little bit of a battle between the two? We have an issue. So this is something that I talked about before. A couple people I noticed in the comment section were saying this is ridiculous, but you have to understand when they are this tied together and suddenly there's a problem, this is going to hurt people. Whatever happens to the banks, and I don't care about that. It's the regular people that have to suffer because of all these activities that are taking place. You need to have multiple trading partners. It's the same thing with you as an individual. Yeah, you can buy most of your food at the store, but wouldn't it be wise to have some of your own supply at home? The same thing with your income. If you rely on one income, that's dangerous. If that income goes away, oh, you know what? I've been in the same job for 20 years. My industry is never going to get replaced, this and that. How many times this happened? And not to mention, what if, and it happens so often, a health issue, either for yourself or maybe your spouse, suddenly takes you out, and now you don't have the income you did before. It's heartbreaking, but it happens. I hear about it all the time. Okay. What about this? Charting the global economy, IMF slashes growth estimates. I don't really care about the IMF and what they have to say in particular, but I do like their reports because they do highlight where there are concerns. I've written extensively about the IMF in both of my books, but anyway, just looking at this weaker outlook, the IMF sees growth in 2022 and 2023 lower than it did in January. And of course, if inflation goes up, these will continue to go down. And then let's look at this. Supply chain snarls. Keeping you waiting, Montreal's port has a pitch. Reliability is worth the 620-mile river detour, according to the port CEO. You see this? Inland docks along St. Lawrence are seeing more business from Asia, so they're having to wait on both ends. This was an interesting one, okay? I hope you can see this in here. But, here's all the ships around New York. That's very popular. We got Texas. You've got right here, South Florida, LA, Long Beach, Vancouver. But what about Montreal? Yes, they have to come around all the way in here, 1,000 kilometers or 620 miles. But this is a port that is capable of handling quite a bit, and yet not as busy as the rest. See, this is the kind of thing that should be happening more often naturally, because when you've got something so busy like this, it presents a bottleneck, a concern, and now that has really spiraled out of control. We are learning the result of having this, whole just-in-time inventory. I don't know if insanity is the right word, but certainly I don't think it's wise, and now we're seeing why. This is really good. Okay, so Statista put this out, and take a look. So it's flipping back between April 2019 and April 2022, and you could see each one of these lights is like a ship. So if it might be a little bit difficult to see. If I could zoom in, maybe you'll see a little better. So this is Shanghai. And that's one of the busiest ports in the world. And just look at this. If you could see how it flips back, okay? All it's trying to show you here is that there's way, way more ships. Way, way more ships. If I could come down a little bit. Here's Ningbo. So like I was telling you, Ningbo, if you could see how many more is there as well. Like I said, it might be difficult to see. But essentially just more stuff coming through, okay? More and more and more and more. And this is just showing us basically the same thing. The sea adjacent to the Ningbo port is showing signs of elevated ship traffic. Then you see this, Port of Shanghai, 14-day average maritime shipment volume, starting from the partial lockdowns in Shanghai, then the full lockdowns, and now it has come up a little bit from there, but we are not back to where we were before. This puts additional pressure on everybody involved, you and I. If we get anything from there, directly or indirectly, we are going to be impacted. If you go to a restaurant and they need something from China, they're gonna be affected, okay? Whether that's napkins and who knows what else. Everything is affected by this. Kathy Wood says the Fed won't hike as much as the market priced in. That's what the general retail trader has talked about, okay? And certainly they're, used to getting this information, all sort of, the same talking points. To me, I don't care about Kathy Wood in particular. I just think it's a very, like, it's kind of like looking at Jim Cramer. It's sort of this one group of individual who just refuses to look at reality sometimes. I mean, it's okay to be realistic. It really is. But apparently, for some, I guess when you have billions of dollars that you want to keep in your funds, you don't want to be realistic. We do believe that the Fed is getting a lot of messages right now that it should not tighten too much. What? What are you talking about? Really? And this is ridiculous. Let me know what you think in the comments down below about this, okay? This word disruptive has become so overboard. It's ridiculous. Truly disruptive innovation accounts for $10 trillion, which is less than 10% of the global equity market capitalization. Quote, we believe that $10 trillion will go to $210 trillion in the next 8 years. That's a 40% compound annual rate of return, and we would expect that from our strategies as well. That's very depressed right now. I mean, I don't know in what world that this forecasting model, I mean, it's just crazy, and it is, in my opinion, it's reckless. It's reckless. Bond danger bills with the Fed set to break from its cautious past. I mean, these type of things, this is crazy, ladies and gentlemen. What caution? What are you talking about? Interest rates were at the floor. I mean, they were all the way down. The balance sheet is $9 trillion. There's no caution. Contrarian, who called it China tech sell-off, says it's not over yet. China tech stocks have shed more than 60% from its 2021 peak. You could see it right here, where it has gone. This happens to be Alibaba. And you could see it peaking out in October or November 2020. And it's been heading down further and further. This, it's been going up and down and up and down. Like, think about that. 320 down to where it is today at 86. There was a period of time in which, it dipped down so far. It was at 74. And then within a very short period of time, it was 124. So it rocketed higher. Now, if people got out of that, fantastic. But if people held on, you're basically right back at the bottom again. And look what's happening here. This has happened multiple times before. A bounce up and it falls. A bounce up and it falls over and over and over again. Okay? We see this repeated pattern. Is it the right time? I don't know. You tell me. Okay? And just really quickly, just showing you the outflows from financials on the left. By the dip in tech that's consistently been happening, and that is according to the EPFR, by the way. I'm not just pulling this data from nowhere or speculation or some quote from Jim Cramer or Kathy Wood. That's actual data. Record 8-week inflow into materials, absolutely. The Medicare social media ETF is down to the levels we saw at the peak of January 2018. This is the net percentage of central bank tightening. And in my opinion, this is so important. We are back at the levels seen in the financial crisis, never at these levels before, okay? And it's going to get obviously more intense. What does that tell you? Not just the Fed, people. It's a global concerted effort to increase interest rates right now. Everyone's bearish, but redemptions are just starting. Cumulative global equity flows versus the all-country world index. It's showing us the indexes have started to fall. And could we see the equity flows going in that direction? I don't know. I don't know what people are going to do, where they're going to put their money. Are they going to go to put it under their mattress? Probably not under the mattress, knowing that inflation is taking hold. We will see what happens as time goes on. If you found the video informative, hit that thumbs up button. It's right down there. Don't go anywhere. Wait, hold on. Did you hit the thumbs up button? No? Hit it. Come on. Support that channel. All right. I appreciate it. I'll see you on the next one. Take care.